Have you ever looked at your portfolio of 30 different index funds and wondered why your total return looks like a flat line? You are definitely not alone. When most investors open their first brokerage account, they are flooded with advice telling them to spread their money as thin as possible to protect themselves from loss. Mutual funds, international bonds, gold, real estate trusts, and small cap value fill the recommended lists. Yet, hidden in that safety net is a structural flaw that prevents your wealth from ever truly taking off. Now, if you are like the typical saver, you have heard the word diversification more than hello in the financial world. But you might not actually realize how that strategy is keeping you broke. Perhaps you feel frustrated when one of your stocks doubles, but because it only makes up 1% of your account, your total balance barely moves. Maybe that one aggressive friend who bet big on a single tech giant makes you feel like you are stuck in the slow lane. Either way, you are likely questioning if this safe path is a proven strategy or just a way to guarantee you never outperform the crowd. Well, here is a reality that might shock you. Diversification is often just diworsification, a way to add more mediocre assets to your life while diluting the power of your best ideas. It is actually a defensive posture that protects you from total failure, but also protects you from total success. And mastering the art of concentration could represent the gap between retiring early and waiting until you are 80 because your safe portfolio grew at the speed of a snail. My name is Noah, and I spend far too much time analyzing risk ratios, conviction levels, and the reasons most people would rather be comfortably average than uncomfortably rich. If you want to learn how to manufacture wealth without spreading yourself too thin, make sure you hit that subscribe button and like this video if it helps you clarify your financial future. Here is what most folks miss about the "don't put all your eggs in one basket" cliché. The typical professional will buy a little bit of everything, and every safe addition they make is another weight dragging down their potential for life-changing gains. One fund might track the tech sector, while another tracks utilities. Some have fancy names like global diversification, while others are just piles of average companies. Yet, in almost every scenario, a mediocre return is waiting for you like a ceiling you can't break through. The reason this strategy is so popular isn't because it creates the most wealth. It is because it is easy to sell to people who are afraid of being wrong. Think of it as a participation trophy for your money. Instead of a championship, it provides a safe seat in the bleachers. But before we explore why this is so limiting, let me ask you a quick question. When you look at the world's most successful investors, do they own 500 companies? Or do they own 5 or 10 that they understand deeply? You are likely thinking of names like Buffett or Munger. These are people who built empires by betting big on their best ideas. Well, the truth is that the safety of diversification is often a mask for a lack of knowledge. When you own everything, you understand nothing. Now, does this sound too risky? Why wouldn't you want to protect your downside? These questions are vital because they explain why the diversification trap is the reason your portfolio feels small. Your account is essentially a soup with too much water. Just as a diluted drink loses its flavor, a diluted portfolio loses its growth. This data helps you spot the difference between being a collector of stocks and being a builder of wealth. Here is the fascinating part. The obsession with wide diversification is fueled by a massive industry of advisors who need to justify their fees by making things look complicated. There is a specific committee of theorists who believe you can eliminate risk by adding more variables. Think of it like trying to drive a car with 10 different steering wheels. It sounds safer, but it just makes it impossible to go where you want. To escape this trap, you must satisfy strict rules of your own. You have to be honest about your circle of competence, possess the guts to hold through volatility, and show actual conviction in your reports. You also must resist the urge to buy just in case to ensure you aren't just a temporary trend. This rigorous focus is exactly why concentrated investors have historically dominated. You aren't just praying for the whole world to go up, you are backing the winners you've identified. It is like having a laser beam instead of a flashlight, but instead of light, the prize is your financial freedom. But there is a detail about averaging out that might catch you off guard. Even though diversification lowers the risk of one company failing, it also lowers the chance of one company making you a millionaire. The more you add to your basket, the more you move the needle toward a result that looks exactly like the index minus your fees. So when a once-in-a-lifetime opportunity appears, it carries your portfolio no higher than the rest of the market. This means your diversification actually drives a huge portion of your stagnation. We are talking about the loss of upside. When you are spread across the world, you can't win big. Now, having your money in 1,000 places isn't a strategy. These are small slices of companies that often compete against each other. They have survived economic shifts, but they don't produce explosive wealth. Investing in everything is essentially betting that you aren't smart enough to pick the best. But here is the part that many fund managers won't tell you because they need you to stay in their diversified products. A concentrated portfolio of high-quality assets has a track record of growth that wide funds can't touch. For decades, the best results have come from people who found 3 or 4 great businesses and held on for dear life. Think about that reality. You have people with 50 different stocks who spend their weekends reading 50 different reports. They get stressed trying to track a dozen different industries while their total return is identical to a savings account. And yet, the majority of them continue to add new sectors year after year. It is like a person trying to win a race by wearing 50 different pairs of shoes at the same time. The data is quite embarrassing for the over-diversified crowd. Research shows that once you own about 20 to 30 stocks, the benefit of adding more is almost zero, but the cost of complexity keeps rising. That means, if you kept your focus tight, you would have given yourself a better chance at outsized wealth than if you had just bought the entire planet. How is that possible? How can less be more in finance? The answer is found in the power of the core. While that sounds like a dry textbook term, the idea is simple. The core is the small group of assets that drive 90% of your gains. When you focus on the core, you can research deeper, react faster, and ignore the noise. When you clutter your portfolio with safe hedges, you lose the ability to soar because your best performers are being held back by your worst ones. It is like trying to run a sprint while tied to 10 people who want to walk. You might move forward, but you'll never reach your full speed. This leads us to a core truth of building wealth. It isn't just about not losing, it is about winning. One of the biggest wealth killers is the fear of being wrong that leads to owning too many losers. When you are over-diversified, you might have a steady chart, but you are functionally stuck. That math is terrifying. If you own 500 stocks, you need the entire world to boom to see a real change. But when you own 5 great ones, you only need one to succeed to change your life. You are basically choosing between a participation medal and a gold trophy. These choices also compound. That extra 3% of growth you lose by being safe isn't just a small number, it is the loss of millions of dollars over a 30-year career. Over a lifetime, wide diversification can literally cost you your early retirement. This is why the most aggressive wealth builders ignore the quote-unquote standard pie charts and focus on their highest conviction ideas. They even show examples of people who owned just 1 or 2 great properties or businesses and became wealthier than 1,000 index fund savers. Even with the higher volatility, the concentrated investor often wins because they aren't carrying the weight of the bottom 400 companies. The beauty of concentration is that it removes the quote-unquote noise from the equation. You don't have to worry about every tiny headline or every new sector trend. You get a focused system. When your best ideas grow, your wealth explodes. Over the long haul, high conviction investing has shown an incredible ability to create massive wealth, which leads to consistent power for you. Let's look at the actual numbers, because this is where the theory becomes a reality. If you have $10,000 and put it in 50 stocks, A 100% gain in one stock only adds $200 to your total. But if you put it in 5 stocks, that same gain adds $2,000. That extra growth didn't come from working harder, it came from having the courage to bet on your best idea. This mathematical leverage is the most powerful force in finance. If you start now and just trim your portfolio to your top 5 ideas, you could easily end up with a legacy while your peers are still waiting for their 7% return. That is the reward for having the clarity to be quote-unquote concentrated while you build your future. Now, I know the quote-unquote risk of loss is scary, and you are right to want to protect your family's money. But here's the secret. Real risk comes from not knowing what you own, not from owning too few things. Think of your portfolio as a championship team. You only want the star players on the field. When your concentration is high, your potential is unlimited. When the next big shift happens, and it always has, the person with the focused portfolio is the one who captures the gain while the diversified saver just stays level. Successful investors don't want to be quote-unquote protected from growth. They want to be quote-unquote exposed to it. It is like choosing to be the owner of the winning horse instead of betting $1 on every horse in the race. But you will still hear critics. Financial media will claim you are quote-unquote gambling or that you are quote-unquote ignoring the basics of risk. They will show you scary charts of single companies failing and talk about the quote-unquote safety of broad funds. What they won't show you is the opportunity cost of the 40 years you spent being average. Complexity sells because it makes the investment industry look like a necessary shield. But in the world of money, the simplest path to a massive portfolio is the one where you back your best horses with everything you've got. You have to decide if you want to be quote-unquote standard or if you want to be quote-unquote exceptional. Sometimes being wealthy means choosing the narrow, intense path. Diversification isn't a safety net, it's often a cage. Whether you decide to cut your funds in half or just stop adding new ones, the key is conviction. The best strategy is the one that lets your winners run, not the one that drowns them in a sea of losers. If this helped you rethink your pie chart, please give this a like for Prime Noah Invests and let me know in the comments. Are you a diversifier or a concentrator? See you in the next one.